The other piece that I wanted to talk about, because this is another thing that I go over with clients when it comes to the interest rate, is the 10-year Treasury note, or the like the Treasury bond market. Has anyone like heard those terms before? Are they familiar with them? Jackson, maybe? Okay. So what I like to do, and I don't know if it's possible, but am I allowed to share my screen?
Gloria, are you able to?
Yeah, you have sharing.
I did it.
We go.
I did it.
Okay.
So can you guys see my Google screen here?
Yes.
Okay, cool. So what I like to do, I have it saved like in a bookmark right here. It's just a 10-year Treasury note. So you can, if you just Google 10-year Treasury note and search for that, it's like the first thing that pops up. I don't know what this is, but I like this market watch right here. This is the one that I like to use because I'm used to using it. And all it does is it shows you what the 10-year Treasury note is. Now, this is important because this isn't the mortgage interest rate. It's not the starting mortgage interest rate, but this is what mortgage interest rates are. They correlate with this Treasury note. Okay, so it's been very interesting to watch this Treasury note rise over time, right? So this is kind of showing you. Wish we could go back a little bit further. So this is showing you the trend of the 10-year Treasury note. So you can see that back in, July of 2020, this thing was at 0.6, and this is back when rates were like 2%, And so what was interesting is at the start of January or 2021, we were at a 1% 10-year Treasury note, and the rates were like I think when we posted this, it was 2.99, and we had been sitting in like 2% rates the whole year. And then as soon as the new year ticked, we went above 1% in a 10-year Treasury note, and rates went to 3.25. And that was a big deal because rates hadn't been free in a long time, right? And so all of last year, it's just kind of, you see it kind of went up, and then it came down a little bit. I'm sorry, this was in 2021. And then in 2022, my fault, guys, I'm sorry. In 2022, it was 1.5, and the rates were 3, okay? And then after that, it started to spike up very quickly throughout the entire year, okay? And what's been interesting about this is, as you can see right here, the 10-year Treasury note is, I don't know if you can see, it might be kind of small, but it was 1.5, okay? And this is when rates were 3. So mortgage rates this year have been double what this 10-year Treasury note is. If you follow this all the way through, and like right now, it's 3.4, and rates are about 6.5. Like, I don't know if we sent out a rate update. Hopefully we did, and we're a good company. But I post our rates pretty frequently. Yeah, so as you can see, this was from January 23rd. So this was, what is that? 23rd would be Monday. So Monday we posted rates at 6.5, and these are kind of average going rates right here. So this would be like kind of like baseline rates, right? So for conventional and FHA and VA, we're assuming that you have, a 750, 760 credit score, and that it's a max loan amount, and these are primary residences. So, these will change depending on folks' scenarios, but this gives us a good baseline, right? And so when we go look at this, it's almost double what this 10-year Treasury note is. And so I've been explaining this to clients as we go, just like, hey, look, watch the 10-year Treasury note. This is going to tell you what rates are doing. As clients like look at homes, that way they're not surprised when the rates change, when they get pre-approved 2 months ago, and now they're going to buy and the rates are higher. Or, as you can see, sometimes lately the rates have been lower. So this is a really cool tool to use. I kind of put everybody onto this graph just so they're in the know on how rates work. And then another thing that's really, really cool about this is I was at dinner with an executive for one of the investors, one of the lenders that we work with, and I was telling him, we were talking about this, and I was telling him how I started tracking this year, and it's been super interesting to see, where mortgage rates are versus where this graph is. And I was telling him, it's about double what the 10-year Treasury note is. And then he's been in for much longer than I have. And so he was educating me on the fact that this is not normal. The fact that the 10-year Treasury note, or that the mortgage rates are double what that 10-year Treasury note is. Normally it's a fixed factor. right? So normally, like at the start of 2022, we saw that the 10-year Treasury note was 1.5 and the rate was 3, right? So that spread is 1.5, right? So now if we go off a fixed spread, which is in a normal market how it works, if the 10-year Treasury note is at 3.5, then the rate should be 5, right? Add 1.5 to that 10-year Treasury note. So as you can see, the mortgage rates are still pretty inflated right now, and it's due to just the craziness that happened, right? It's due to the fact that inflation was shooting through the roof. So the feds are like, well, we're just gonna keep raising the rate, right? And when the feds raise the rate, by the way, it's not the mortgage rate and it's not the 10-year Treasury note. It's the average daily trading rate between banks, okay? Which does affect all the other rates, but right, because we saw the market like aggressively react to them raising the rate. And then another piece on that, I hope I'm not losing you guys because this is very interesting to me, but I tend to talk fast. So if you have any questions, I'll stop in a second. But what's interesting about the Feds raising the rates, right? Feds raising the rates, it's not, because I get that call a lot, like, hey, the Fed's raising the rates, on Wednesday, I want to lock in right now. And it's like, well, if the Fed's raising the rates on Wednesday, and it's Monday, the market's already reacted like 2 weeks ago, right? So when the Fed had when the rate rose throughout last year, the actual mortgage rates had risen about 2 weeks prior to that. And so now what we're seeing over the past couple times when the Fed when the rate rose, when they raised the rate, we've actually kind of seen a stagnation of rates, right? Because after we saw it react so violently last year that it's already still kind of inflated right now, they've built, margin of error in there. And that's what I think we're going to see kind of come back down as the market stabilizes. That margin for error is going to compress. So that is my 2-minute spiel on how the mortgage market and rates work. Did that make sense, or did you guys have any questions about that?
So Douglas, are you thinking then that where we are now is 6.5? You think it's going to go much higher?
I don't think so. I don't.
Okay, I was out.
I don't
That's
think
what
so.
I
I
was
think we're
thinking.
I think we'll probably see rates stay right here. I mean, much higher. I don't think we'll see them go much higher. Maybe they tick up into 7 again, because from what I hear, it's not supposed to go down until 2024. But I don't think we're going to see it like as you saw that mountain that was rising like this. I don't think we're going to see that again.
Yeah, very interesting
Okay.
about the U.S. Treasury note. I wasn't familiar with that, but are they parallel in terms of like if the Treasury note goes up, then interest rates go up, or is it like a delay? Like if it's been up for like maybe a month or so, then you can expect mortgage rates to go up.
No, it's pretty much like I'm looking at this thing every day. Like when I come in, like I've already looked at it this morning. I'm pretty much tracking the 10-year Treasury note every single day because as this thing moves, mortgage rates are moving as well. Like almost, it's in tandem. Like the Treasury, if the Treasury note is at 3.4 right now, if it drops to 3.2 right now, like if we just saw it drop on this chart, then in about like 10 minutes, I would be getting a bunch of emails from all the lenders and investors saying reprice for the better. Or if it went up, I would be getting a bunch of emails saying like rate locking, frozen, repricing for the worse. And it's based off of this 10-year Treasury note. It's like they're simpatico, as my dear friend Justin Timberlake says.
Wise words.
Yes. All right.